All right, let's get started with the first conversation of the day. And it has to do with asset allocation, but it has to do with the maintaining of asset allocation, because often you will need to rebalance your portfolio. We'll talk about the importance of that, and then we'll go into the tax aspect of it. Let me first introduce my guest. We've got Arvind Rao, who is a chartered accountant, certified financial planner, and the founder of Arvind Rao and Associates. Thank you so much, as always, Arvind, for taking the time. How important in the larger context of things is rebalancing of your portfolio? What do you need to bear in mind when you go in for rebalancing?
Hi, Alex, and good evening to you. Portfolio rebalancing is, in my view, as important as setting up the portfolio, because normally when an investor goes about setting up the portfolio, there are certain expectations, there are certain assumptions on the basis of which, and I would like to add, there are even some ratios on which basis the portfolio is formulated. So portfolio rebalancing is nothing but relooking at the assumptions or ratios that originally were taken into account for the portfolio, and if there is any imbalance in it, you need to set it right. Now this imbalance may occur either due to the market conditions not being suitable, or at the same time it could even be in an imbalanced state where the markets have turned more than favorable. So over the last 1.5 years, where we have seen like a spectacular performance in the equity markets, typically portfolios have been in a situations where the equities have been more than favorably balanced, thereby creating the equity allocation in the portfolio to be slightly more in weight than the other components in the portfolio. So this is where the rebalancing is required, and it can be done periodically, or I should say it should be done periodically, or even if there are some certain events that trigger an imbalance in the allocation, that could also invite attention to this aspect. Normally, the people shy away from booking profits, but they are more than happy to book losses. And I think that is where the whole concept of portfolio rebalancing becomes important, because while it is important to cut your losses, we generally say it is also prudent to book profits so that it no longer remains notional profits, but you're able to have some profits in your bank as well, which can then flow into either fixed income or gold or any other assets that are a part of this portfolio.
Let's talk about this in a couple of scenarios, and I want to also understand how you would go about this rebalancing. Is it something that you would do, first of all, if you are investing into the equity market, say, in a lump sum basis? You're not doing it systematically over the course of months. Do you then do this on an ongoing basis where you're saying you're going to reduce your allocation towards equity and put more money aside in fixed income? If there is an imbalance in that form, if equity, for example, has overshot to a large extent, or do you book profits? What would you do? Would you correct something? And how often would you look at it? Would you look at it once every 6 months, once every year? Or do you set a boundary saying that if you have 60% allocation to equity, if it crosses 70%, I will rebalance it and bring it back to 60?
Let me start with the first question here. So in this example, the ideal situation is that if the allocation in the portfolio has been kept as 60-40, wherein 60 is in equity and 40 is in debt, and you keep a track of this. If the portfolio reaches a stage where it is where the equity is now 70 or even 75%, or let me rephrase, if the objective of the portfolio was that if the equity asset class in it was assumed or expected to give returns of say 15%, for example, and we find that in reality the equity component is now giving you a 25% returns, because of which the component of equity in it has gone higher, then that is exactly the situation where it becomes prudent to do a rebalancing, thereby removing part of the equity and diverting it into the other 40% bit, which let's say for the time being is fixed income or debt segment. So you park the money there so that again equities and debt comes to 60-40. There is no fixed time limit, but I think let's put it this way, is that one should have a scheduled time when they have a look at the portfolio, because normally people get so busy in their day-to-day lives that they are more than happy contributing to their portfolio, but find it quite a boring task to relook at the portfolio and make these changes. So there should be a scheduled time in which these portfolios are looked at. And second, if normally at these scheduled times, if there is any imbalance, it could be corrected, or even if not, if there are certain specific occasions where one finds that the market has suddenly jumped up, like if you see continuously the market going up by 500 to 1,000 points for a week, and people are nowadays a lot tech savvy, they keep looking at the portfolio via various of these portals that show this data. So there, if they find that suddenly their shares or funds are showing superlative performance, that could be the other trigger to do this rebalancing at that point in time.
Okay, so a short question before we get into the tax aspect, Arvind, because I think a lot of people following programs like this one will plan long-term investments into equity based on their long-term goals. So for example, if somebody wants to buy a house in 10 years time and is investing in equity with that in mind, their contention would be that if the equity markets in a couple of years have given supernormal returns, then their goal is going to be achieved in less time. So then in that scenario also, should they rebalance?
Now this is really a tough one, and this is where I think every investor will have to take that call, because rebalancing is not only to be done at a time when the equities are positively heavyweight. There could be situations where the markets are not doing well or are going on the downward trend, in which case this 60-40 could also become like a 50-50 because equities are lower. So at that point in time, what portfolio rebalancing would imply is that you pick some money out of the debt, push it to equity so that it again comes back to 60-40. So in this journey, in the past, whatever studies or research has been done on asset allocations, what has been seen is that constant rebalancing, whether it is on the positive side or on the negative side, is where the secret lies for a steady performance in the portfolio. But Alex, I totally agree with you. It's a very tough call to take, because when the markets are moving up and you see your portfolio giving you fantastic returns, there is definitely a feeling that if this run is to continue, I'm definitely going to reach my goal faster than anticipated. But and I know I am sometimes conservative in this respect, that definitely it looks good, but if you are able to book at least that portion of the portfolio which is beyond the expected performance, like in the previous example I took, I said that if you have got 25% returns as against an expected 15, then that 10% that you are looking at super performance or the additional is what I would suggest people to book, so that tomorrow, if there is a correction, they are not disappointed that they missed out converting their notional profits into actual profits.
Right. Fair enough. Unfortunately, we have only a little time to talk about the tax aspect, but I think you can cover this fairly quickly, Arvind. The idea of tax harvesting, it's not something that we speak about very often, but it can actually be very lucrative in that it's something that is provided for in the tax laws. You can book up to 1 lakh of capital gains in a year in equity without having to pay tax on it. How do you use that to your advantage?
That's right, Alex. In fact, one of the major roadblocks in people's mind when we talk about portfolio rebalancing is that if I were to sell my profits, or if I were to book my profits, I'm going to incur some tax cost on it, which is correct. But although taxation is one of the main considerations, that's where tax harvesting is more looked at as a favorable tool. And I would add that there are two main elements here that one needs to keep in mind. One is, of course, the what you mentioned, Alex, that long-term capital gains on equities are exempt to the extent of 1 lakh per annum, and only gains beyond this are taxed. But at the same time, one has to keep in mind that any short-term losses that one incurs, this can be offset against both short-term gains as well as long-term gains. So since we are not very far away from this financial year end, and if someone finds that there are good long-term gains booked, so one is, of course, they can check if it is crossing a lakh. If not, then they are within the threshold of 1 lakh up to which they are not liable to pay tax. Or secondly, if they find that the long-term gains are more than a lakh, then they should go back and check in their portfolio if there are any short-term losses available, which today, of course, are notional. So what could be done here is that they book these losses now so that it translates into booked short-term losses. And they may want to carry forward this position later, which is you rebuy into those same shares or the same equity mutual funds again for the longer term. But by booking it now, what advantage you get, or what advantage is offered by the Indian taxation system, is that you can offset the short-term loss against the long-term gain and thereby not pay or minimize the taxes that you pay on the long-term gains. This is a very much within the four corners of the law, and doing this will result in reduction of the tax liabilities and is, of course, very helpful for the taxpayers.
Especially for those who are investing in equity for the very long term, right, Arvind? Because you're talking about cumulative returns over a long period of time. At some point of time, you're going to have to book profits. And you have to take the money out for whatever purpose you've set aside for, right? So instead of paying all of that tax at that point, perhaps it makes sense, like you're saying, to do so over the course of several years. But thank you so much for that very comprehensive conversation. It's been an absolute pleasure speaking with you.
Thank you so much, Alex, for having me here again. Bye-bye.